Hello everyone! Today we will discuss how to lose money, how whales manipulate you, and how news gives you the wrong information. Don't get too caught up by whales manipulating the market right now, and of course, this includes crypto markets. Look, sometimes whale activity helps us, but regardless of whether or not we're on board, whales use a variety of tactics to advantage themselves. And that's actually a major reason why about 90% of people are losing their savings. Unfortunately, unless you guard against it, whales use people like me, probably people like you, regular, everyday small investors. They use us as exit liquidity. But I'm about to show you some of their tricks and some of their schemes so you can better defend yourself. The more you recognize their strategy and really understand what is that they're doing, the safer you're going to be. Most often, whales prefer to fly under the radar. They're kind of stealthy creatures, actually, despite their size. However, they do have some telltale signs and reflect some typical trading patterns. It kind of goes something like this. Asset accumulation followed by a pump, reaccumulation followed by a pump, distribution followed by a dump, redistribution, and then a dump. This is the standard pattern, and by following this pattern you can find out their manipulative tricks. So here's their first tactic, range manipulation. This is where whales reduce their entry price, and they do this by pushing prices. Before I tell you about an example, you can access all of this information for free and even more: trading strategies, latest news, analysis, and reminders. Everything that we wished for in our time is available right now for free in our Telegram channel down below in the description. So let's continue. For example, by keeping the prices in a particular tight range, this shakes out quite a lot of traders and they exit with a loss. Now, it's quite possible that the whales reverse after breaking key levels. They could be after they touch these levels maybe 4 or 5 times. This can be either on the top or on the bottom. Here's another important tactic: to identify the fair value gap, or FVG. You can observe an FVG during strong pumps or dumps, and as a result, we can see serious price shifts and chart gaps. We often see a pullback after a good pump. This benefits whales because those who entered late might sell their tokens, and so FVG is all about volume by price. Well, in other words, real liquidity on the table. Here's a strong buying or selling sentiment in the market. However, there are not enough counter orders to match the action. Okay, another crucial tactic that we have to keep in mind is faking patterns and really creating false patterns in general is what this tactic is all about. So, for example, whales buy a resistance or sell during a bounce. Meanwhile, retail traders rely on patterns as market indicators. However, the whales influence the market direction by creating false patterns. And so, as a result, retail traders buy or sell based on these misleading patterns. So that means that they buy or sell at entirely the wrong time, giving whales an opportunity to take advantage and increase their profits. And here's another big one: stop-loss hunting. Whales are constantly on the lookout to find stop-loss orders at key price levels. Once they locate them, their next step is to drive prices towards these levels. Then, they start to execute notable buy or sell orders, which triggers the stops and causes rapid price fluctuations. And so, if this market pulls back hard under this level and then consolidates and comes back, we're likely to sell and stall. We also have to be on the lookout for stop runs. This is a tactic to push prices past critical levels, and this can be both support and resistance levels. And this results in triggering stop orders. Then, as a consequence, it creates cascading price changes. However, whales then typically quickly reverse within this range. This way, they catch traders off guard and they can capitalize on stop liquidations. This tactic is kind of like stop-loss hunting that we just looked at, but with some nuance difference. Wash trading is next, and with this technique, whales create artificial volume. The whale buys and sells the same asset at the same time, so it looks like there's a lot of activity. However, what's really happening is a single whale is creating all kinds of fake activity. Now, whales use various wallets for this or various exchange accounts. So, to clarify, only the volume seems high, but in essence, nothing really happens. Whales only move an asset between wallets or accounts. And sadly, this one is encouraged by exchanges for the most part because they want it to look like they're trading with a lot of volume, but then in fact, they're not. They have an incentive to tolerate this kind of whale behavior. For that reason, unfortunately, next up we're looking at spoofing here. This is then a whale creates large buy or sell orders, but they have no interest in actually executing these orders. So it looks like there's a demand for an asset, but in reality there isn't. In other words, whales manipulate order books, which is also known as dynamic layering. This completely misleads traders as well as bots, but it also has an impact on price movement. Now, the best way to avoid spoofing is to trade on reputable exchanges. They should, or at least they're supposed to, prevent spoofing from happening. Spoofing and wash trading are similar, but the difference is that wash trading, that's where whales trade with themselves. Closing the jaws, this is another tactic to influence prices. Whales place large buy and sell orders, and they do this at closing prices. This results in market prices going up or down, and the combination of descending buy walls and ascending sell orders greatly flattens the price action. This results in trapping retail longs shorts to sell the orders above. Then the whale exits the longs up high and at the same time scoops up more on the way down. Hence the expression, because as a retail trader, this can very much have you trapped in their jaws. To learn more about whales tactics, check out our free Telegram channel, and there are a bunch of useful materials, latest news, analysis, and even more. Imagine you would not need to read a bunch of articles, be dubious about events in crypto, and like scenarios of what will happen. Now, everything will be clear, and that is all for free. So check out the link if you want to upgrade your understanding of crypto and trading. So your best bet is to seed the compression out, and then you can identify it. And finally, let's talk a little bit about two-sided markets. This is when a whale places big orders on both the bid and the ask side. They create a rally and sell into this same rally, or they press the price down and buy the dip. However, retail traders can only trade in one direction, and as a result, they can get run over. So the lesson is really not to chase every price swing. Generally speaking, to avoid getting caught up in this, we have some useful tips. Use stop limit orders instead of market stops. Wait for confirmation before you start trading. Before you react, let key support or resistance levels break clearly. Don't buy pumps or chase assets that have suspicious volume. Take a close look at ask and bid spread and check liquidity, not only the volume. And don't chase breakouts. When ranges compress, stay patient instead of and stick to your plan by waiting for the right moment. Let me know if you recognize any of these tactics used by whales, and if you've been able to identify them in the past and perhaps hopefully save yourself a lot of headache in that process. And if so, did you manage to successfully avoid the snares? Let me know also if I missed any tactics that you're aware of in that video, and if we didn't cover any of them. I'll be happy to hear your thoughts about that in the comments below.